Hi, everybody. Damon Nickle here with Delaware Wealth Planners.
Brent
With me,
Bonstingl.
as usual, Brent Bonstingl, and welcome to the end of July. It's the 22nd of July right now, and a lot of people are going to start thinking about back to school time here
Already?
shortly.
Yeah.
Already. And I know what you're thinking. You're thinking, books and folders and maybe a new laptop or a tablet or something like that. But you know what financial advisors think about? TAP 529
Sure do.
accounts.
They sure do.
So,
and for those of you that are unfamiliar with TAP 529s, we'll kind of start with a little bit of an overview of what a 529 plan is and what it isn't and how it works and things of that nature. But if you have kids that you're thinking about for the future, and maybe even for yourself if you're looking for another tax tool to benefit you in the future, TAP 529 plans are state-run, tax-advantaged plans. The contributions are made with after-tax dollars, meaning that it's money.
And they're earmarked for educational purposes.
Specifically, yes.
Yeah.
Well, at least originally they were. The use cases have expanded dramatically in the last 10 years. Some of the things you can use them for, it goes beyond higher education. You can now use them for K through 12, private education, public schooling, trade, technical, and even vocational schools. You have to check with each place if it's allowable or applicable, but most places allow for them, and there's pretty wide-ranging uses, so we can kind of cover a little bit of that too.
Yeah. Well, who can open a TAP 529 account?
Anyone.
Okay. So you can open it. You don't need to be the parent.
Nope.
You could be grandparent, aunt, uncle, cousin.
Even rich Uncle Scrooge.
It could be somebody you're just friends with.
That's it. Doesn't have to even be family related.
Okay. Gotcha.
Yep. There are a couple caveats though, and it's more so once a 529 plan is opened by anyone for anyone, what happens to those funds? That's a little bit more specific. So anyone can, to Damon's point, anybody can open a 529 plan. You can open it for a friend or a friend's kid. But once money goes into a 529, the use cases are a little bit limited. But like we said, they go along for anything to do with higher education, anything to do with private or vocational schools. There are a couple other things, a couple other use cases too.
Trade, technical, vocational, K through 12, up to $20,000 a year. So you're a little limited on that, where for college you're really not.
It used to be a pretty good number. I guess these days it's more expensive.
Yeah. Private school can get very pricey these days, but you can use it for that purpose.
And that's per year, not total.
And that's per year, not total. Correct. So it's let's just real quickly. It's an account like any other investment account. You make contributions into it. In this case, after-tax contributions. Inside it, you have a selection of investments. It should be noted that these plans are run on a state-by-state basis.
Yep.
Every state has their own TAP 529 with a chosen vendor that operate. Like in Pennsylvania, it's Vanguard. I forget who it is in Delaware.
Might be American Funds.
Yeah, maybe American Funds. But they're state by state. But here's the cool thing. You don't have to use the TAP 529 plan of the state you live in. Like, for instance, a lot of our TAP 529 accounts for our clients are Virginia-based.
Yep, and that's because of the investment selection.
Right.
And there are actually free, easy-to-use resources. Believe it or not, the IRS has some very good resources to help you compare TAP 529 plans from state to state. There are different tax benefits to each state. And as Damon mentioned, like for Virginia, there's a very open architecture where you can have many more investment choices and options, and you might find better investment choices in the Virginia plan than you might in PA or Delaware. But then again, it depends on the state you're living in. And it also depends, you may not, depending on how old your child is, or the beneficiary of the 529, you may not know if they want to go to college or not. You may not know which college or which state they're going to go to. Or you might be a family that has gone to this, every single person in your family lineage has always attended the same school every single time.
Right.
So perhaps that state benefit is more beneficial to you and your family than it is to somebody else.
Right.
So it's worth comparing is the short version of it.
Yeah. So let's talk, we talked a little bit about the money going in, it grows tax deferred. Let's talk a little bit about taking the money back out.
Yes.
So what can you do with it?
There are some gates and limits, and I think that's a really good point. So if you use it for higher education, as Damon mentioned, money goes in after tax, so it's after tax money that you've already earned, paid taxes on. The real benefit, it works very similar to a Roth IRA. That money will grow tax deferred. You're not paying taxes while it's growing.
Mhm.
And if you use it for any one of those qualifying higher education, technical trade, or vocational purposes,
Mhm.
including, there's a long laundry list if you want to
Yeah.
name a few things that can go
Yeah,
towards.
tuition, the typical ones: tuition, room and board, supplies that could include things like software, computers,
Laptops,
subscriptions, internet access, and a very very broad other category called special needs.
Right.
So
Right.
you can use it for any of them, and that means that when you take the money out, you pay zero in taxes on the gains, as well as, there's no penalties. You pay zero taxes on it when you take
Tax
it out.
free.
Tax free if you use it for
any of those
one of
purposes.
those qualified
Yeah.
purposes. Yeah.
Now, I guess that leads to another question, though, is what if you don't? Or what if you don't spend it all?
Yeah, that's always been the one of the knocks on a TAP 529. One of the concerns is, okay, I set up this TAP 529 for my son or daughter. I set it up 6 months after we were issued their social security number, and I been putting money away now for 18 years. They're not going to college.
Well,
what happens?
Well, maybe they started a business and they didn't need to, but
maybe they didn't need to. Any number of different reasons. So there's a number of things you can do on the, okay, what if it isn't needed for that beneficiary? The first one is real simple: change the beneficiary.
Now, does this just go to like another child if you have more than one?
Any
child?
relative.
Wow.
Any relative, including yourself, by the way.
Yeah.
So you can always, so if you have, you have two children, only one ends up going to college, but you've got a TAP 529 for both of them, you can change the beneficiary on this one to the name of the other child, or aunt, uncle, niece, cousin, grandchild, anything that you want.
It's not anything,
anything,
but it's a pretty wide-ranging definition of family member.
Yeah. We'll call it extended family
Yes.
in the extreme.
Aunts, uncles, cousins, nephews, and spouses of all.
Yeah. So what if there is no other logical choice to change the beneficiary to?
You mentioned one thing is you can change the beneficiary to yourself.
Yes, true.
And I think that's an important note, because one of the things that means is, even if you're not planning on going back to school, why would you give it to yourself? Because if you wait 15 years after the account's been opened and in your name, you are allowed to convert a portion of those assets into a Roth IRA in the name of the beneficiary. Now, that could be for your child originally, or if they didn't use the funds, or maybe you opened this account and hope to have kids and you never did. You can use this for yourself to roll over up to $35,000 to a Roth IRA. There are some annual limits.
Yeah, that's just in the last handful of years, that Roth rollover rule. That almost sounds too good to be true. I am betting there's some limitations on that.
There's a couple.
Okay.
One is that you're limited to $7,500 per year as a maximum, and you have to have earned income, or the beneficiary, better yet, the beneficiary of the 529 plan has to have earned income in the year you're doing a conversion. So, very simple example: if you earned $10,000 in a year, you can convert up to the maximum of $7,500, which is the lower of the two limits. If you earn $5,000 a year, you're capped at $5,000 in a conversion.
Okay. And of course, the account has to be around with that beneficiary on it for 15 years before you can do that. And then you can do a maximum of $35,000, but in chunks no bigger than $7,500, potentially smaller than that, depending on if they have an income or not.
An important footnote to that point is, if you change the beneficiary, it resets the clock.
It resets on the 15-year clock.
Just keep that in mind as well. But what are some other things you can do if you don't turn it into, if you don't have anybody to change the beneficiary to, and if you don't want to convert it over to a Roth IRA, you just want to take the money, do you have that choice?
Yeah, you can take the money out, but they make it a little bit painful, because then it's treated essentially like a regular taxable account, but worse. The money you take out, you're going to have to pay capital gains, if there are capital gains, which there probably would be after 18 years.
Well, you actually have to say hopefully.
Hopefully there are gains on that after 18 years. So if there are capital gains, you would have to pay capital gains on that, plus a 10% penalty on the gross amount. And unlike an IRA, where that 10% penalty goes away if you're 59 and a half. This penalty never goes away. It doesn't matter how old you are when you take it out. If it's not coming out for an educational purpose, that 10% gets tacked on.
That's right. And to that point, though, for those of you who are out there just feeling a little bit confused as we're running through things quickly, essentially, if you don't use it for another family member, if you don't turn it into a Roth IRA, and you just want to take the money back out of a TAP 529 plan for yourself, you can do so, and it would basically act as if it was a regular brokerage account the whole time, except for you're paying the additional 10% penalty. So it's a 10% risk to put it in there. The tax benefits are pretty large, though, because if you have the money growing in a TAP 529 account for even 10 years, you would expect that even at a fairly conservative rate of, say, let's say 7% or less, you should expect the money to double over a 10-year period just based on compound growth. So it's a very beneficial tool. It's a great tax saving tool. And if you have kids and you're thinking about back to school, if they aren't going to college this year and they're a little bit younger than that, it certainly has a lot of advantages. And you can even use it for loan repayments as well.
Oh, that's right. You can use the funds up to a maximum of $10,000 to repay student loans.
Private or federal.
Private or governmental, I believe. Yeah. Up to $10,000 is the maximum on that. So there are multiple different uses, and these are accounts that we can open they're like popcorn. We can open them very quickly for clients and
they're relatively low cost on top.
They're very low cost. Yeah, I mean, I'm not even charging a fee on these.
Yeah, we typically do not. What I would also say too is if you have any questions on 529 plans, or if they might not seem right for you, but you might look to be saving for your kids for the future, give us a call. We're happy to talk about a few different options in addition to 529s as well.
Yeah.
Well, have a great rest of your summer. We'll check back in a month.